Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, what we're looking at today is the U.S. market analysis for Monday, March 16th, 2026. Let's dig in and see what it's telling us about where things stand. This video presents a direct informational narration of the source document. Okay, first things first, we've got to go through the required risk disclosure and important notice. So just bear with me here. This document is purely for informational and research purposes, all right? It's not investment advice. You know investing has significant risks, including the potential loss of your principal. Prices can go all over the place, totally unpredictably. All the market views in here are just for reference. They are not guarantees of future performance. Any investment decision you make has to be your own, based on your unique circumstances. And of course, market conditions can materially affect performance at any time. And what happened in the past? Well, it doesn't tell you what's going to happen next. And finally, the information we're looking at is very time-sensitive and is subject to change. So here's the game plan. We're going to start with the big picture stuff. You know, geopolitics and what's happening in the energy markets. Then we'll zoom in a bit to see how all that is hitting market sentiment. After that, we've got a special look at a huge player, NVIDIA. We'll check out how the big institutional investors are reacting, touch on a couple of big market events on the horizon, and then, at the end, we'll pull it all together with some potential strategies from the report. Sound good? Let's get to it. So, right off the bat, what's the bottom line? The core summary says we're caught in this weird spot between a geopolitical, they call it an information fog, and big institutional investors getting super defensive. Now, on one hand, you've got this long-term hope anchored by NVIDIA's vision of hitting $1 trillion in revenue. That's kind of the stabilizer. But in the short term, a couple of things are really spooking investors and making them cut back on risk. First, there's this potential ripple effect from crude oil prices. And second, there's the technical shock of what's called triple witching this Friday. That's when a crazy amount of options and futures all expire at once. So that combo is forcing the big money to deleverage, basically to sell assets and lower their risk. The S&P 500 is sitting at a really critical point, and it feels like the whole market is just holding its breath, waiting to see what happens in the Strait of Hormuz. All right, let's jump into our first section, geopolitics and the energy market. The report uses this phrase, an information war, and you're about to see exactly why. Okay, this slide really gets to the core of why the market's so jumpy right now. We're still processing the U.S. strike on Iran's Kark Island, and diplomatically, it's a mess. The report calls it an information trap. You've got President Trump saying one thing and Iran denying any communication, and the analysis here says that denial is a deliberate move to throw off oil traders. So how do you figure out what's really going on? Well, you don't listen to the words, you look at the data. And that's where the AIS vessel tracking system comes in. It's the physical proof. It shows that traffic through the Strait of Hormuz has not bounced back. Those few ships, mostly just Iranian domestic vessels. The big commercial fleets, they're basically in a transponder blackout. They've gone dark. This is the hard evidence, and it's why that risk premium on oil isn't going away anytime soon. So this puts us at a major fork in the road with two very different outcomes ahead. On the left, you've got the best-case scenario, what the report calls the window period. If ships start moving freely again within 2 months, the shock to global supply chains will probably be manageable. We can handle it. But if this blockade drags on for 6 months or more, we're looking at a structural rupture. And that, my friends, is a whole different ballgame. It's a systemic repricing. We're not just talking about higher gas prices. The report warns this would signal a shift from just short-term inflation to full-blown structural stagflation. You know, that awful mix of no growth and high prices? So with all this uncertainty swirling around, how is the market actually behaving? That takes us right into section 2, the standoff, the stalemate between how people feel about the market and what the technical charts are actually saying. You know, the S&P 500 is just teetering on a tightrope. The report calls it an extremely compressed dynamic equilibrium. Institutional sentiment has been all over the place, swinging from calm to panic to pain and back to hope, just violently. You can see this chaos in the options market, where you've got both huge bets on a rally and massive bets on a crash at the same time. Now, if we look at the actual numbers, the key levels, the S&P 500 closed at 6623 last Friday. That's right on top of a super important support zone between 6600 and 6570. To really shake off this defensive mood, we'd need to see a solid recovery above 6900. And what's really interesting is this decoupling that's happening. The link between oil price swings and the stock market has gotten weaker because all the attention, all the focus has shifted over to the AI story, which is really the NVIDIA story. And hey, that brings us perfectly to NVIDIA, the company that's at the heart of all this AI hope. So for Section 3, let's take a look at why this report sees a pretty big disconnect between where the stock is trading and where it could be going. So the real anchor for this entire analysis is this quote from CEO Jensen Huang at the GTC conference. He laid out a very clear, very explicit strategic target, hitting $1 trillion in revenue in fiscal 2027. That corresponds to the annual report that will come out in January of 2028.
Okay, let's break down the numbers in this table because they tell a really weird story. So the stock opened at 182.97. High expectations, right? But then what happened? Traders sold into that strength, a classic sell the news move right in that 187 to 190 resistance zone. The stock ended up closing at 183.22. And after hours, it dropped even further to 182.65. Now here's the crazy part. Based on that $1 trillion revenue target, the report's midpoint valuation for January 2028 is somewhere between $182 and $273 a share. The price right now is literally at the rock bottom of that range. So what gives?
Well, what it means is there's this massive valuation disconnect. From a strategic point of view, the report is saying NVIDIA's price around 183 is at the absolute low end of its forward-looking value. But still, the stock pulled back right after the huge announcement. This just goes to show how irrational the market can be when that macro panic we talked about takes over. So is there any real systemic threat to NVIDIA's trillion-dollar dream? According to this analysis, just one, a defensive risk. If oil prices stay high for too long, those big tech companies might have to shift their spending away from AI expansion and toward just defending their business. So if the market's in a panic, what are the big players, the institutions, actually doing with their money? That's what we're going to get into in Section 4, taking a look through the lens of hedge funds and those automated trading systems they call CTAs. Wow, the big funds are hitting the brakes, and they're doing it fast. The gross leverage of long-short hedge funds, which is basically how much borrowed risk they're taking on, it dropped by 5.1 percentage points in just 1 week, down to 218.1%. That's the biggest weekly drop since October 2024. But here's the catch, and this is important. Even after that huge drop, their leverage is still really high, in the 87th percentile for the past year. What does that tell you? It suggests this deleveraging process has a lot further to go. Now, for those automated CTA trading systems, it's all very black and white. Their default setting, their base case right now, is to sell. A buy trigger would only kick in if we see a really strong breakout above those key levels of 67.61 or 68.60. If that happened, it would unleash about $42 billion in buying. But on the flip side, if the market breaks down below that risk zone floor at 63.70, you gotta watch out. That could trigger some seriously concentrated selling pressure from the positions they still have on. But check this out. Here's a fascinating little twist in the story. There are a lot of large short positions, bets that the market will fall, building up right around that 6,000 level. You can think of these like coiled springs. If, and it's a big but if we get some sudden good news on the geopolitical front, those floor shorts could turn into rocket fuel for a short squeeze. Why? Because all those traders would be forced to buy back their positions at once, and that would provide some powerful fuel for a market rebound. All right, coming up next in Section 5, we've got a couple more potential storms brewing on the horizon. There's a short-term shock coming from the derivatives market, and then a longer-term policy concern coming out of the SEC. Okay, get ready, because this Friday is probably going to be a wild ride. It's Triple Witching Day, and that's set to crank up the short-term volatility. We're talking about a massive $1.3 trillion in notional value being settled. To put that in perspective, that's about 30% of the total market volume. Now, in a market that's already nervous and deleveraging, all this position closing and rolling could lead to some really violent swings during the day. The report is basically warning investors to be on high alert for what they call technical liquidity shortfalls. And looking a little further down the road, there's some concern about an SEC proposal to shift companies from reporting every quarter to reporting only semi-annually. As this slide lays out, more frequent reporting tends to lead to more transparency. Companies like Costco and TSMC, who give monthly updates, have actually earned what the report calls a transparency premium for it. But if companies start reporting less often, they kind of become a black box. For big institutional investors, that's a risk factor, and the likely result is they'll just reduce how much of that company they hold in their portfolios. So after all of that, How are you supposed to navigate this kind of market? Well, our final section gets right to it, laying out the investment strategy recommendations and the operating principles suggested in the report. The report really boils it down to these three core principles. First, on asset allocation, it says to maintain NVIDIA as a core long-term holding. Why? Because that disconnect between its current price and its future target creates a nice positioning window. Second, when it comes to timing, be patient. The report advises against aggressively chasing rallies until the S&P 500 can get back above 6,600 and actually stay there. And third, what should you be watching? Treat the large-scale return of those little green dots on the AIS vessel tracking system as your #1 leading indicator that a real reversal in market sentiment is underway. So, let's wrap this all up. The market is basically stuck in a standoff between fear and hope. The final word from this report is that until all this deleveraging pressure is gone, the smartest approach is to stay incredibly flexible with your cash and laser-focused on core fundamentals. That really is the key to navigating the kind of dislocation we're going to see with this week's triple witching. So stay flexible, stay focused, and wait for that fog of uncertainty to finally lift.